Welcome, Chuck. I want to welcome you to the first edition of Take Five. This is an idea that we brought to the table from our clients. These are 5 questions that our clients have been asking our advisors, and it's an opportunity for me to relay them to you as our Chief Investment Officer. So thanks for coming and sharing some time with us today.
Of course.
Yeah, it's been a long anticipated recession, maybe the longest anticipated recession I've ever seen, Chuck. The Fed has aggressively raised rates at the fastest pace in 40 years. In your most recent commentary to clients, you said the optimism that investors are expressing via the stock prices looks like they're already looking past a recession. Should investors be bullish, or are they going to be surprised here?
Well, I think they're getting a little bit ahead of themselves, but you have to remember that in 2022, the market was down pretty sharply, over 20%. And so it was already discounting that recession. This is, as you say, one of the most widely anticipated recessions for a long time. And it keeps on getting pushed further out. Even in 22, we said it wasn't going to be a 22 event. It was more likely a 23 event. And as we got into the end of 22, I said it sure doesn't look like an early 23 event, maybe late 23. And here we are on the verge of the second half of 23, and it looks like it's a 24 event at the earliest. So I still think that a recession is fairly likely, but I don't see a lot of the conditions in place to have a recession. In fact, very few. And I think there's some nice tailwinds to the economy that, if you like, have to be overcome by the Fed in order to produce a recession. So I think a recession is still likely. It's just not here yet. And I still am inclined to believe that when it comes, it's likely to be mild. And stock prices are kind of a mixed bag. So you have some companies that are very highly valued. And in many cases, that's fair. These are high growth companies with lots of tailwinds. AI is going to help them. It's all the big technology companies that everybody knows of. But the rest of the market is pretty cheap. And you can find lots and lots of very cheap stocks that are already priced for recession. So I don't see the market as being all that vulnerable. It can go down anytime, 5-10%. That's not a big deal for the stock market to go down. Any reason would do. And in fact, you don't even need a reason, just people pull back. But I think valuations are reasonable.
Well, that actually was one of my questions from our clients. A few weeks ago, we talked about the Super 7 tech stocks that have really made the performance of the NASDAQ and the S&P. The S&P is up about 13% year to date. The NASDAQ, respectively, is up about 34%. But if you look at the equally weighted S&P, it's actually only up about 3 or 4% year to date, meaning that the rest of the market is not part of this bull move that we're having in the stock market. Clients are asking, how are we managing when we have that kind of a situation where only 7 or 8 or 12 tech stocks are making any kind of progress? And how do we make the argument of keeping diversified in all the sectors when there's only really 3 sectors up year to date?
Yeah, well, that's exactly part of the problem, right? So the other part of it that you didn't mention was that if you exclude the top 8 or 10 companies, the whole rest of the market is down in 2023 after a pretty dismal 2022. So that's why I don't see the stock market as being expensive. But you do have to be very selective, and you have to think about what it is that you're investing in and the type of investor you are. So if you're just buying the market as a whole, then yeah, the market might be expensive because some of those tech stocks are really expensive. On the other hand, you can make a reasonable case for companies like Amazon and Alphabet and Meta and Apple. They do have good growth prospects. Whether they are overpriced or underpriced is very debatable. It's the non-7, the non-10 that I think are unambiguously on the cheap side. And that's why I'm very comfortable with buying those companies. I think you have to look at the big 7, the magnificent 7, very carefully and be very judicious about which ones you invest in, if any. And I think there's a case to be made for some of them. I would be comfortable owning some of them. But certainly you're not going to see them perform in the next few years the way they have in the recent past. And you are going to see the rest of the market do better on a relative basis. It's hard to get too hurt when you fall out of a basement window. And there are a lot of cheap stocks out there. And those are, of course, the ones that I'm most comfortable with. I'm a bit of a cheapskate, so I like to buy good companies when they're cheap. And that's why I'm so comfortable with large parts of the market.
Chuck, most of our clients that have come to us, they're coming to us with purposes for their portfolios. There's a purpose for it, either diversification, income, and I'm going to ask you a little bit later about the income scenario out there for income investors. But many of our clients are in balanced portfolios where there's a combination of stocks and bonds. And for the past 15 months, the Fed has been raising rates 500 basis points. We have a pause. Fed fund futures is seeing maybe one or two more rate hikes. So we're at a point now where you can get investment grade corporate bonds at a decent yield. Do you agree that this might be a good time to lock in some fixed income for our balanced clients who might have been out over their skis a little bit with their allocations of too much equity to bond?
No, we're still pretty cautious about the bond market. So you're absolutely right. The Fed has hiked a lot and very quickly. And that's shocking to a lot of investors. It's why the housing market dropped so sharply last year. It wasn't that people couldn't afford the higher mortgage rates. It was that home values had increased, mortgage rates had increased, and they were just shocked by the speed of everything. So they pulled back in the hope that maybe things would go back to lower levels, cheaper levels. In the case of the bond market, I don't see long-term interest rates as being particularly high. I think there's still a fair amount of risk there. When you have a 10-year treasury yielding 3.5%, that just doesn't provide all that much of a cushion relative to inflation. So yes, rates have gone up a lot, but keep in mind they were at historic lows.
And they were at zero.
They were near zero, which is very, very historic.
Yeah.
So we've moved up a lot, but I don't think we've quite moved up enough yet. And so we're keeping our average maturities on the short side. And right now it's not only painless to remain on the short side, it's actually beneficial because the yield curve is inverted. So you get higher yields from shorter term securities at the same time that you're protecting the value of the assets. So I find that a very easy sort of decision to make. And I do think that longer term bonds are still somewhat risky because the yields just aren't high enough.
Let's take that a little bit further. We build many of our portfolios for specific distribution levels. We call them target balanced portfolios. And of course, your income with growth portfolio, which for the last 25 years has averaged about 6% annualized return gross. What are some of the challenges for the income portfolio builder today? Are you seeing opportunities or challenges?
I'm actually seeing far more opportunities than challenges. I'm, if you like, actually holding income down, believe it or not. I'm trading off a little bit of income to pick up a little more rebound potential. The yield on the portfolio, the gross yield on the portfolio today is a little bit over, it's in the vicinity of 7%.
This is your income with growth strategy.
Income with growth, right. So it's producing about 7%, and it's because there's so much yield available all over the place. So those value stocks, which are cheap, because the stock prices are cheap, the yields are on the high side. So I'm getting higher than normal yields out of almost every single sector in the S&P. There are even a few technology stocks that offer some yield, which is kind of surprising. So you can get yield without a problem. And then I'm trying to, avoid having an excessively high yield. And by that, what I mean is when people see the yield on income with growth, they assume, well, this has got to be very risky. There's no way to get this kind of yield without taking a lot of risk. But in fact, right now, that's not the case. There's a lot of yield available in a lot of sectors of the stock market. So I'm actually pushing yield down slightly in favor of a little more upside in terms of growth. And right now, it's pretty easy to do.
As a chief investment officer meeting with your committee, you must highlight near-term and longer-term stresses that you see and are at least monitoring from the top down on a fiscal and monetary policy in the economy. What are some of those near-term stresses or longer-term threats that you might see for investors?
Well, a lot of it reflects what's happening, which is that the labor market is still very tight and growth of the labor force is fairly slow. So the entry into the labor force is running at the rate of about 50 to 100,000 people per month. And job growth has been well in excess of that. So I think that inflation pressures are still a major risk to the economy. It's interesting the way the media covers it. The media points out that growth has slowed, and that's right. But good luck telling a traffic cop you don't deserve a speeding ticket because you just slowed from 120 to 100 in a 65 zone. That's what the economy's done. It's gone from 500,000 jobs per month to something between, let's say, 250 and 300. So absolutely growth has slowed. But it's going to slow more, and it'll slow more even if the Fed doesn't hike rates, because we're running out of people to hire. So growth is slower. Potential growth is slower because labor force growth is slow. You have 10,000 baby boomers retiring every day. So inflation risks are sort of embedded in the system. And the Fed is very concerned about that, which is why it hiked rates by so much. It was late to get started, but they figured it out, and they're probably going to keep at it. So that's one of the significant risks that I see to the market and to the economy over the next few years.
I know at the beginning of this interview, I told you these are 5 questions for clients, but this actual last question is from me. So it's been 25 years, and you've been in this business a lot longer than that. So I guess my question is, what has surprised you most over the last 25 years or even further? And what has remained the same in your career that you don't get surprised about?
Well, I have the gray hair to prove that, yeah, I've been around for a while in this business. It's kind of interesting. I would almost say the same thing about what surprised me and what hasn't surprised me. And it's the way people behave. Whether it's investors or whether it's regulators, they have made glaring mistakes, and sometimes they don't even learn from their mistakes. I thought the 2008 credit crisis was an enormous failure on the part of a lot of players. The banks for letting them be forced into making bad mortgage loans. And they were forced to do that by the Community Reinvestment Act that was pushed by Barney Frank, the same Barney Frank who then pushed Dodd-Frank. So we created conditions that caused the housing market to collapse, really bad policy, and they didn't learn from that, and they almost pushed the economy into a depression in 2008 by letting Lehman fail and making other associated mistakes. And guess what? Silicon Valley Bank, the Fed was regulating that bank, and they were in there and they saw their portfolio, and they didn't do enough to push back the bank to take less risk. So people do take risks. They don't realize the stuff that could happen. And then regulators make it worse. And then, of course, try to fix the problem with more regulation, which often makes the situation more difficult to deal with. So human behavior is, without a doubt, the single most important thing that both drives the stock market up and down, fear and greed. And we see policy mistakes all over the place. And trying to anticipate some of those mistakes is not always easy, but you do know that the market is going to be volatile, and you have to prepare for that.
Thanks, Chuck. We're going to keep it to 5, and we'll see it again. We'll do this quarterly if that's okay with you.
Absolutely.
All right. Thank you very much.
Take care.